Hi, in this video, we will learn about gross income and income situs and the different types of income taxpayers. So we already have a knowledge regarding income or an intro regarding income taxation. So in this particular video, we are to learn what income is taxable and who are the taxpayers who is liable to pay tax based on our income status and based on the income that is taxable. So for this video, we are to learn the following items. First, the gross income. What is gross income? We are to define gross income. We need to learn the elements of gross income. Next, we are to talk about the income situs, so the different situs of income. And lastly, the types of income taxpayer. So we start. Gross income. So gross income is known as income for taxation purpose. So if ever we say income, it is equal to gross income. That is for taxation purposes. Okay? So if ever you will learn soon or you will hear or you will read in your textbook gross income, it means income for taxation purpose. So income is all wealth that flows into the hands of the taxpayer. All wealth that flows into the hands of the taxpayer. So any increase in the taxpayer net worth, so any increase in taxpayer net worth is considered as an income. Any increase is considered as an income. But take note, not all income is considered taxable. Not all income is considered taxable. So you must know whether that wealth that flow inside the hands of the taxpayer is a return of capital or a return on capital. So what is the difference between a return of capital and return on capital? When we say return of capital, your capital or the amount of your money is merely returned. It's merely returned. So for example, you invested 500,000 and there was a return of that money, 500,000. Although there is an increase on your net worth, that is not considered an income because it is a mere return of capital. So take note, if the wealth increase is a mere return of capital, it is not taxable. It is not taxable. But if the income is a return on capital, here we have an excess return out of the capital. Okay, so if that is a return on capital, we will tax it. So for example, you have an investment of 500,000. When the investment was returned to you, aside from 500,000, you have 50,000 interest. So the 50,000 pesos is a return on capital. That is taxable. That is taxable. So this income includes all wealth, all income. So whether that is gains, whether that is a disposition, we include it. Okay, so sir, how about our income arising from, let's say, drug selling? Is that part of our gross income? Yes. So our law does not distinguish whether the income is a legal income or an illegal income. Whether it is legal or illegal, it is taxable, so long as that wealth that flows into the hands of the taxpayer increases its net worth and it is not a mere return of capital, then we can tax it. Now, of course, one thing that we have learned here in this definition is the increase in wealth. So what do we really mean by increase in wealth? So an increase in wealth actually is a presumption of an increase in income, or it is an income. Nasabi naman na natin yan kanina. So when we say there is a flow of wealth in the hands of the taxpayer, we have an income. But we need to distinguish this, again, as a mere return of capital or a return on capital. However, the problem in your increase in wealth is, what if it cannot be proven? What if it cannot be proven? Okay, so if it cannot be proven, the BIR normally do this method. We call it your net worth method. So for example, there is an increase in wealth. However, there is no tax that was paid by the entity. How do we know that there was really an income? The BIR does this method. We call it your net worth method. So the BIR can now determine the income of the taxpayer with that is based on the increase in wealth. So in the absence of any reliable accounting records, we compare the net worth. So for example, year one, the net worth is 300,000. Year two, the net worth now is 500,000. We presume that the 200,000 here is the income. We presume that the 200,000 here is the income. So any increase in wealth is an income. Hence, in case there is an increase in wealth, but there is no declaration as to the income, the BIR can determine now the income by just comparing the increase as to your net worth. Okay, so normally, if ever the BIR will make this particular net worth method, you can still dispute it. You can dispute it. Sir, how can we dispute it? Kasi ang ina-assume natin, di ba, yung buong 200,000 income agad yan. Yun yung ina-assume natin sa net worth method. Paano ba natin i-dispute yan, sir? Hindi naman talagang 200,000 ay income. You can dispute this one by presenting your audited financial statements. Audited financial statements that a portion of that increase is a return of capital. Okay? That a portion of that increase is a return of capital. Okay. So again, an increase in wealth is considered an income. How does your BAR determine your income based on your increase in wealth? That is your net worth method, wherein you compare the taxable periods. Any increase in wealth is considered an income. But this is only a presumption. So how can you dispute that actually that is not your income? You can dispute it by presenting your audited financial statements. That your audited financial statements now will show that a certain portion is a return of capital and a certain portion is a return on capital. And we go back to our first discussion that only return on capital should be taxable. Okay, so I hope we're clear here regarding your gross income. Gross income for taxation purposes is income. So whenever you hear gross income or you read gross income per taxation, we mean income. And when we say income, any increase in wealth, any increase in health, any increase in wealth, but not a mere return of capital, but not a mere return of capital. Okay? So what are the elements of gross income? So what are the elements of gross income? First, there must be a gain or profit. So there must be a gain or profit because again, if there is no profit, what it is only a mere return of capital. It is a mere return of capital because we said the return must be greater than the capital. So we call it your return on capital. Example nga natin kanina, if you invested 500,000 for an investment and when the investment was returned, you receive 550,000, the 50,000 is the gain or profit because that is the return on capital. That is the return on capital. Okay, so under your return on capital, what are the different rules based on the decisions of the Supreme Court? So return on capital includes loss profit. Includes loss profit. Why? Because guys, for example, you are a farmer. You insured your farming for 500,000 pesos. Okay, so that 500,000 covers both your capital, which is let's say your seeds, your fertilizers, etc. worth 200,000. And then of course the excess now is the assumed income. Okay, So here, your loss profit of 300,000 is taxable. Why? Because here, the 200,000 is the return of capital, while the 300,000 is the return on capital. Here, although there is a loss profit, you still earned it through the insurance, which is for 300,000. Hence, the 300,000 is considered return on capital because what you receive here is not only a payment out of your capital, but a payment also on your return on capital. That's why loss profit is considered a return on capital. However, guys, if that is a damage, whether it is a compensatory damage, actual damage, moral damage, exemplary damage, those are considered return of capital, therefore non-taxable. Non-taxable, you exclude them in gross income. So again, if there is a damage, compensatory, actual, moral, exemplary, those items are considered return of capital because they are only an equivalent of the capital loss, not a loss profit. I hope we're clear with this. Again, compensatory, actual, moral, exemplary damages are considered return of capital, therefore they are non-taxable. So soon, if ever we will go into your different problems and it was included in the income of the taxpayer a damage, then that damage is not considered return on capital. It is excluded in gross income. I hope we're clear here. However, guys, if ever that is a loss of victims' earning capacity, loss of victims' earning capacity, this is still considered loss profit. Loss profit. This is again a return on capital. This is a return on capital. We consider this one as included in gross income. Sir, what do we mean by loss of victim's earning capacity? This happens whenever the victim is, let's say, was hit by a truck and he was hospitalized for 3 months. And because of that 3 months hospitalization, he was unable to report for work. And hence, he did not receive any compensation for the 3 months. If ever we are to claim damages because of loss of victim's earning capacity, that is considered lost profits. So although that is a damage, guys, that is a damage, but if that damage is a return of lost profit, it is still taxable. So you need to distinguish whether that damage is merely a return of capital or a return on capital. Take note, if there is an excess out of the capital employed, that is already a return on capital. But the amount that is not an excess or equal only to the capital, that is a return of capital. Okay, so again, any excess is considered return on, but the amount as to the capital is a return of capital. So lost profit, loss of victim's earning capacity is considered a return on capital, therefore included in gross income. Okay. Also, capital items with infinite value are non-taxable. Okay, so what if there is a return on capital? However, this capital item has an infinite value. What do we mean by infinite value? It is incapable of pecuniary estimation. So we cannot estimate the value of that particular capital. Okay, so if that capital is with infinite value, it is always a return on capital. Okay, again, if the capital is an infinite value capital, it is always a return on capital. No, it is always a return of capital. Since it is a return of capital, guys, what will happen here is it is excluded as part of gross income. As part of gross income. Okay, So because it is incapable of pecuniary estimation. So for example, you receive a damage, and that particular damage is a payment of a an item which is incapable of pecuniary estimation, then it is non-taxable. So what are these capitals with infinite value? So what are these capitals with infinite value? So the following are capitals with infinite value. First, we have your life. Second, we have your health. Third, we have your human reputation. So these items are incapable of pecuniary estimation. Sir, what do you mean by capable of pecuniary estimation? Hindi mo alam kung anong halaga niya. Napakahalaga niya na hindi mo na alam kung anong halaga niya. Okay, so you cannot really estimate how much is the value of that particular capital. So those items are life, health, human reputation. Of course, you cannot say that you are worth 1 million pesos. That's too cheap for a life. Okay, that's too cheap for a life because really your life cannot be estimated as to its value. So in case these items will have a return, the whole return on these items, whole return on these items are considered not part of gross income because they are only a mere return of capital. They are merely a mere return of capital. Again, because we cannot estimate the value of these items. However, there is an exemption as to life. So what if you insured your life and you receive already the insurance? That means that you outlive your insurance. So normally your insurance kasi ganito. How does your insurance work? You pay premiums. You pay premiums. So let's say 10,000 per month for 60 months. And then it will seed after 20 years. You will receive a total amount of 10 million pesos. Okay. So what if you outlive your life insurance? So assuming, ganito kasi ang life insurance, pag namatay ka, makukuha mo na yung buo. Pero pag hindi ka pa namatay, makukuha mo lang siya pagka nag-lapse na yung period niya. So let's say nag-lapse na yung 20 years. So after 20 years, buhay na buhay ka pa. You're alive and kicking. You're alive and kicking. So what will we do? What will we do? What will happen to that 10 million pesos that you receive? This is not already considered as a return for your life because hindi ka pa naman namatay. Clear? Hindi ka pa naman namatay. You think of it as an investment already. You think of it as an investment already. Sir, pag namatay ako, na-receive ko yung 10 million, okay lang yon. Hindi siya taxable kasi para siyang compensation over your life. Clear? Kasi nga sabi natin, life is incapable of pecuniary estimation. Pero naman sir, ganito, hindi ako namatay, na-receive ko yung 10 million. Doon na siya magiging taxable. If ever you outlive your insurance, because here, the insurance is not already a compensation over your life, but it is considered as a mere investment tool in which you earned an amount out of your premiums. So the excess of your premiums will be the amount of your income. So for example here, 10 million yung ma-receive natin. Magkano lang per month? 10,000. 10,000 times 60 is, wait, I'll just multiply it. So this is 600,000. So you have here 9.4 million. The 600,000 here is a return of capital. The 9.4 is the return on capital. So if ever health and human reputation, these are in form of damages. And we already said that these damages are non-taxable. These damages are non-taxable or not part of gross income. Now for life, still it is non-taxable. However, take note, if ever that is a life insurance, namatay ka, na-receive yung life insurance mo, dun siya non-taxable because it is treated as if a compensation over your life. And a life is incapable of pecuniary estimation. But what if hindi ka pa namatay, na-receive mo na yung premiums mo or na-receive mo na yung return mo? It is considered as if an investment. So you earned a money out of your investment of premiums monthly. Hence, any excess out of your premiums is considered return on capital. So we have here 10 million. That is the amount of the insurance which will cede to the beneficiary. And 600,000 is the total amount of your premiums. The excess, which is 9.4 million, is considered a return on capital. Okay, so I hope we're clear. Lost profits, damages, a mere return on capital. And lost profits is a return on capital, while your damages, life, health, human reputation, is considered a return of capital, except for life insurance in which you outlive it. The excess is considered taxable. It is treated more of an investment rather as a compensation over your life kasi hindi ka pa naman namatay. Okay? That's for number 1. How about for number 2? So for number 2, we have here the gain or profit must be realized or received. The gain or profit must be realized or received. So what do we mean by realize or receive? When we say realize or receive, we mean that the income must be credited to the taxpayer. The income must be credited to the taxpayer. So when we say credited to taxpayer, it inures to the benefit of the taxpayer. It inures to the benefit of the taxpayer. So here, we say that the income is already realized if ever we receive it. But take note, receive means actual or constructive. So whether it is actual or constructive, it is considered realized. It is considered realized. Okay, so again, when do we say that it is realized or received again? If ever there is an inure of benefit to your taxpayer, or it is credited to the taxpayer. Okay, whether actual or constructive. So for example, you have 550,000 pesos. That is the total return out of your investment. So the 500,000, sabi nga natin, yun yung investment mo or yung capital mo, yung 50,000 yung excess. So pag na-receive mo yung buong 550,000, yun ay actual benefit. Pag meron ka ng right to receive dun sa 50,000, ang tawag naman dun ay constructive receipt. Okay? Because you have the right to receive. Actual means actual receipt. Constructive means the right to receive. But take note when we say realize or receive, as long as it inures to the benefit of the taxpayer, then it means that we realized an income. Okay? It means that we realized an income. I hope we're clear as to number 2. Number 3, the gain or profit must not be excluded by law or treaty from taxation. The gain or profit must not be excluded by law or treaty from taxation. What do we mean by this? So your income must not be excluded. Your income must not be excluded. So what are these exclusions? We call them exclusions from gross income. We will learn all of these items as we go through to our discussion. So we call them exclusions from gross income. So these items are excluded. Which excludes this gross income? What particular item excludes this gross income? It can either be from the NIRC, it can either be from special laws, or it can either be from your constitution or from treaty. So for example, a non-profit, non-stock educational institution is exempt as to the income actually directly and exclusively used. So those items are, again, excluded. So any exclusion provided under the law, constitution, or treaty, even if it is a gain or profit, even if it is realized or received, if it is excluded, then we do not place it as part of your gross income. Okay, so what are these elements of gross income again? These are the different tests wherein we can say that the income is taxable or not. Okay, so the income is taxable or not taxable, or it is included or not included. When can we say it is included? If the 3 items are present. But what if there is a gain or profit and it is realized or received, however, it is excluded by law or treaty from taxation, then it is not included. For you to include it, all the elements must be present. All the elements must be present. So we must learn soon that as we go through to your different types of income and the law explicitly do not tax that or exclude that, then we cannot add it on your gross income. And those items that are excluded are called exclusions from gross income. That is our future topic when we go to your regular income taxation. Okay? So what are the different sources of income? Okay, so remember our rule is territoriality. So what does your territoriality provides again? Under your territoriality, any income derived from sources forms part of the taxpayer income. Okay, so alam naman na natin tong whatever source, right? Sabi nga natin, whether legal or illegal, kasama yan sa income. As long as income derived siya. Pero, tinitignan lang natin din yung territoriality principle natin, in which we can only include income in sources within the Philippines. Okay. Ang whatever source dito, ang ibig sabihin niya, pwedeng legal yang source, pwedeng illegal yan. So whether legal or illegal, it forms part of our income. Okay? So when we say income again, gross income. So what are the different sources of income? Whether legal or illegal, it can be a property income, pwedeng labor income, pwedeng sale. So when we say property income, it is the gain on the property. Gain on the property. So normally, when we deal the property, we have a gain or loss that can be. When we say deal on the property, we sell the property. So we call it dealings in properties under your income taxation. So dealings in property ang tawag natin, hindi siya sale of property. In taxation, we call it dealings in property. And when we say dealings in property, it can be a gain or a loss. But normally, what is the source of income as your property? Of course, only the gain. If that is a loss, we cannot say that it is an income. How about your labor? What is the source of income as your labor? These are your different services rendered. These are your different services rendered, either as a professional income or as a compensation income. So long as you rendered a service and you earn a labor income. Okay, so here we call it your professional income or compensation income. Next, we have your sale. Next, we have your sale as a source of income. This is for the ordinary course of business as to those who sell. These are merchandising, manufacturing, those items that provide for or engage in the selling of goods. Okay, so what are the sources of income? It can either be property, labor, or sale. But any income derived from this property, labor, or sale, whether it is legal or illegal, forms part of the taxpayer income, with the exemption that it must be an income within the Philippines. But later, we will learn that in your different situs of income. Okay? So take note lang ha, ang kailangan natin sagutin sa video na to ay ano ba yung income na matatax? Ano ba yung income na matatax? Ang sabi natin, gross income, not mere return of capital. Saan ba manggagaling ang mga gross income na yan? Pwedeng sa property, pwedeng sa labor, pwede sa sale. Pag property, sabi natin, dealings in the property. So, binebenta natin yung property natin. Sir, anong property? Pwedeng personal, pwedeng real. Sir, ano ang real? Ano ang personal? Pagka real property, ito yung mga lupa-lupa natin. Pag personal property, ito yung mga items na pwedeng igalaw nyo kung saan-saan man. Pwedeng sasakyan, pwedeng yung necklace mo, pwedeng yung cellphone mo, those are personal properties. However, guys, per taxation, we do not classify it as real or personal. Soon you will learn that per taxation purposes, properties can either be a capital property or an ordinary property, or sometimes it is known as ordinary asset or capital asset. And we will learn that in our next meeting. That is your dealings in properties. Next, we have your labor. For labor, to to form part as an income, it must be either a professional income or compensation income. But any source of income from services rendered is considered a labor income. Another source of income is your sale. This is based on your ordinary course of business, which is the selling of merchandise or manufacturing. So these incomes are part of the taxpayer's income. So pwedeng tatlo, pwedeng isa, pwedeng wala. Okay? Basta ito yung mga sources of income. So pwedeng pagsama-samahin yan, lahat yan may income siya. Pwedeng isa lang dyan yung income niya. But take note, these are the different sources of income. We go now on the taxability of your income. So whether that income is taxable within the Philippines or taxable here in the Philippines or not. So what do we mean by income situs? When we talk about income situs, we look as to the place of taxation. What particular territory has the right to tax that particular income? So alam mo na yung mga sources of income. Ngayon, ang kailangan nating alamin, aling territory ba ang pwedeng mag-tax ng mga income na yan? That will be answered through the situs of taxation. So the general rule is that we have your territoriality principle. So what is this territoriality principle? That the taxing power cannot go beyond the territorial limits of the taxing authority. So we can only tax within our territory. You cannot go beyond our territorial limits. Situs really is the necessary taxation within the state, in which the state has the jurisdiction or exercises dominion over the subject income. So take note, ano yung mga subject income natin kanina? We have your labor, property, and sale. Okay. However, here guys, as you can see, as to our income situs, hindi na ninyo siya madi-divide ng labor, property, or sale. Kasi meron tayong different situs rules as to the properties or as to the income, whether it is labor or sale. Okay. So first, we start with real property. Who has the right to tax a real property? A real property is taxed in the state in which it is located. A state in which it is located. Okay, so when we say a state in which it is located, wherever you can find that property. So let's say you can find that property here in the Philippines, then it is taxable here in the Philippines. Take note, what we need to look here is where it is located. So even if the owner is from other country, but the location is here in the Philippines, we tax it here. Sir, how about if I am a resident here, I have a property outside the Philippines? Do we tax the income on that real property? That is an exemption. But the general rule is the state in which it is located is where the real property will be taxed. So for example, you will sell a real property here in the Philippines. Since it is located here in the Philippines, then we can tax it here in the Philippines. Okay? Next, we have your personal property. For personal property, we need to distinguish whether that is a tangible personal property or intangible personal property. So what do we mean by a tangible personal property? You can touch it. Intangible, you cannot touch it. When we say it is a tangible personal property, where do we tax it? We tax it on its physical location. We tax it on its physical locations. For example, if you sell a personal property which is located here in the Philippines, then it can be taxed here in the Philippines because it is located here in the Philippines. But if that tangible personal property is sold outside the Philippines, then we cannot tax it because it is outside our territorial limits. How about the intangible personal property? So this is based on the domicile of the owner. So normally it is based now on the residence. So whoever has the residence as to our intangible personal property, that's where it is taxed. If the residence here is here in the Philippines, then it is taxed here in the Philippines. But if the residence of that particular owner is outside the Philippines, then it will be taxed outside the Philippines. Sir, what are the examples of intangible personal property. These are credits, bills, deposits, bonds, promissory notes, mortgage loans, judgments, corporate stocks, etc. So those items are intangible personal property. So we have here, let's say, stocks. The stocks is registered in the US, but it was sold here. So where is the domicile of the stock? In the US, because that is the domicile of the owner. It is registered in the US. Hence, it is taxable in the US. Another, a bond issued in Japan. It was sold here in the Philippines, where it was issued in Japan, meaning the domicile of the bond is in Japan. Hence, even if sold here, the taxability of the bond does not fall in the Philippines, but it falls in Japan. Okay, so personal property, look whether it is tangible or intangible. How about if that is a business, occupation, or transaction? If that is a occupation or transaction, we call that one labor. If that is business, we call that one sale. Okay, for business, occupation, or transaction, where do we tax it? So it depends on the place where the business is done. So it depends on the place where the business is done. So whatever, whether it is servicing, merchandising, or manufacturing, if the service is done here in the Philippines, or the merchandise is sold here in the Philippines, or the manufacturing company sold the items here in the Philippines, then it is part of Philippine income. But if it is sold or done outside the Philippines, then it is not part of Philippine income. That is as to our business, occupation, or transaction. We summarize that as either your sale or labor. So it depends on the place where the business is done. So we look as to the place. Is it within or without? If within the Philippines, then here in the Philippines. Without territoriality principle, we do not include it. Okay? Next, we have your dividends. So in your dividends, when can we say that it is part of our income? Dividends, when can we say that it is part of the income and it is taxable here in the Philippines? So in the dividends, we need to look as to the corporation who issues the dividends. Corporation who issues the dividends. Okay, so if the dividend is issued by a domestic corporation, hence that is taxable within the Philippines. Okay, so Philippines has the right over that particular dividend. How about if it is declared by a resident foreign corporation? So what do we mean by a resident foreign corporation? It is a foreign corporation doing business here in the Philippines, however, incorporated outside the Philippines. So for example, Toyota, it is a Japanese company. However, it is engaged in trade or business here in the Philippines. We call that a resident foreign corporation. Okay, so if that is a resident foreign corporation, we have this so-called predominance test. So if the Philippine is dominant, then it is included or taxable here in the Philippines. But if Philippine is not dominant, then it is not taxable in the Philippines. Sir, when can we say that it is dominant or not? So that is the 50% or more or the majority principle. Actually, hindi nga dapat 50% or more yan. Dapat nga 51% para makita natin na dominant talaga yung Pilipinas. Because the majority of the income came from the Philippines. Okay? Predominance test. Majority of the income came here in the Philippines, then Philippines. If not, then outside Philippines. So for example, RFC, we have here your income. Within the Philippines, 1 million. And then outside the Philippines, you have an income amounting to 9 million. So we have here 10 million. If we test the predominance test, 1/10 is only 10%, it will fail Therefore, this RFC, if ever it will declare a dividend, it will declare a dividend. The dividend is not taxable here in the Philippines. Because guys, what happens here is that it did not follow the predominance test. But what if the Philippine income is 9 million, Philippine, and the outside income is 1 million? So we have here 9 over 10 or 90%. If that is 90%, we follow the predominance test. Hence, if ever that company will declare a dividend, it is to be taxed here in the Philippines. Next, what if the dividend is declared by non-resident foreign corporation? If that is a non-resident foreign corporation, the situs is outside the Philippines. The situs is outside the Philippines. Therefore, it is not included. Okay? So again, what is the rule of your tax situs? Under your tax situs, we learn where to tax that particular item of income, whether it is taxed here in the Philippines or not. So we look as to the place of taxation. So for your real property, you look where the place of that particular property. If it's located here in the Philippines, then any gain on the sale of real property is taxable here in the Philippines. But if the real property is located outside the Philippines, then it is a part of the income here in the Philippines. How about personal property? If that is a personal property, we look whether it is tangible or intangible. For tangible, we follow the physical location. If the location is here in the Philippines, then tax. If not, do not tax. Intangible, domicile of the owner. Whoever issued that particular intangible personal property, it is where it is taxed. So if the stock is issued in Japan, it is taxed in Japan. Business occupation or transaction, it depends on the place where the business is done. So if ever it is done in the Philippines, kasama. If not, hindi siya kasama. So for example, sir, manufacturing. Yung na-manufacture ko, binenta ko dito, o di kasama. Sir, parang binenta ko outside, di hindi kasama. Kasi nga, hanggang dito lang tayo. Clear? Okay. How about dividends? We look whether it is domestic, resident foreign, or non-resident foreign corporation. Okay, we go now to your taxpayer classification. Actually, your taxpayer classification, when we talk about income tax, we talk about your individuals, states, or trusts. So when we try to classify your taxpayer as to income taxability, we have this following items. We have 1 to 10. Okay, so for your resident citizen, it is taxable on all income derived from sources within or without. So we have here within and without. Okay, so what do we mean by within, sir? Within means it is earned here in the Philippines. Earned in the Philippines. So based on the situs, based on the situs. So without, earned outside the Philippines, based on the situs. So alam naman na natin yung situs niya, kung saan siya kinikita, whether that is property, whether that is a labor or a sale or a dividend. Okay. Now, if ever it is within, that is an income situs earned in the Philippines. If that is without, that is an income situs earned outside the Philippines. So how do we tax your resident citizen? Do we tax it within and without? Yes, it is taxed within and without. Whether or not you earn it here or earn it outside. Okay? So resident citizen. How about a non-resident citizen? Sir, when can we say that you are a non-resident citizen? You are a non-resident citizen depending on 2 items. First, if ever you give an intention to the CIR that you will stay out of the Philippines, either through your documents, like you are to migrate in outside the Philippines, you are working outside the Philippines, that is an intention. Another is we follow the days. So based on days or length of stay. So dito, ang rule is 365. 365 divided by 2, so 183 days. If majority, di ba majority kasi yung tinitingnan natin. If majority of your days you live outside the Philippines, then you are non-resident citizen. Okay, what is the majority? 183 days. So paano natin masasabing non-resident citizen ka? Based on intention or based on your days or length of stay. So paano yung intention, sir? Sabihin mo kay CIR na hindi ka na resident citizen kasi lilipat ka sa ibang bansa, magma-migrate ka, mag-work ka doon. Or length of stay. Based on your length of stay, 365 over 2, 183 days. Take note, the actual days in a year ang ginamit sa NRC. So pag NRC ka, you are only taxable within sources in the Philippines. Take note, income taxability. What income do we tax? So based on the income situs that we learned, sabi natin, situs means the place of taxation where we earn that income. So whether earned within the Philippines, situs is earned within the Philippines, or situs is earned outside the Philippines. Okay, so resident, within, without. Non-resident, within, on. Next, we have your overseas contract worker. What is this overseas contract worker? These are your different overseas Filipinos worker, or those workers who has an employment contract in overseas or outside the Philippines. So if you are OCW, the income that is taxed is only those income earned within the Philippines. So the situs is within the Philippines. How about if you are an alien? How about if you are an alien? So whether you are a resident alien or a non-resident alien, you are only taxed within. You are only taxed within. Okay? Whether resident or not, only taxed within. And by the way, for your alien, we have your non-resident alien engaged in trade or business and not engaged in trade or business. Sir, how do we determine if it's engaged in trade or business? We use the length of stay test. Length of stay test. So what is the length of stay test here? We use the 360 days. So 360 divided by 2 is 180 days. So if ever you stayed for more than or equal to 180 days, but less than 1 year, then you are considered non-resident alien engaged in trade or business. But if you stayed for less than 180 days, you are considered a non-resident alien not engaged in trade or business. Clear? How about the resident alien, sir? When can we say you are a resident alien? You have two particular tests. It's either the intention, so you place your intention to the CIR that you are a resident now of the Philippines, even though you are an alien, and the length of stay. So normally, the length of stay here is 1 year. 1 year. Okay? So the length of stay is 1 year. So that's for a resident or a non-resident alien. Sir, what if I'm an alien? I'm a resident now of the Philippines and I gained citizenship status. Hindi ka na alien noon, guys. Magiging citizen ka na. Clear? So pagka na-naturalize ka, sir, ano yung naturalize? Yun yung magpe-petition ka to the court and you will have an oath on the Philippine flag that you will uphold Filipino citizenship, then you will become a resident citizen by that time. You are not already considered an alien. Clear? Okay, next. Domestic corporation. What is a domestic corporation? This is a corporation that is organized under the Philippine laws. So what do we mean by organized under the Philippine laws? So the articles of incorporation, it is incorporated here in the Philippines. Sir, ano ang incorporated? Pag sinabi natin incorporated, gamit yung law ng ating Pilipinas, nagkaroon ka ng juridical personality. So, naging corporation ka dahil sa law ng Pilipinas. Sir, how? Through your articles of incorporation, you pass it to the SEC. Now, if you are a domestic corporation, meaning you are incorporated here in the Philippines through the Philippine laws, then you are taxed within and without. Within and without. Okay? Next, how about if you are a foreign corporation? Sir, what is a foreign corporation? A foreign corporation is a corporation that is organized in or outside the Philippines. So, hindi naman ginamit yung Philippine laws dun sa organization niya. Ang ginamit ay outside the Philippines. So, pagka foreign corporation, whether it is a resident foreign corporation or a non-resident foreign corporation, then it can only be taxed within. It can only be taxed within. Sir, ano uli yung within? Situs ng income dito sa Pilipinas. Clear? Okay, next. How about a partnership? A partnership, of course, normally we don't have a non-resident partnership. A partnership will always be a partnership established here in the Philippines. Rarely do we have a partnership that is a resident foreign. It is always a domestic partnership. So, domestic partnership. So, if that is a domestic partnership, you get the income within and without. And take note, guys, for partnership, it is necessary that you look whether the partnership is a general professional partnership or a general partnership in trade. Okay, sir, what is a general partnership in trade? This is a business partnership. Sir, how about a GPP or a general professional partnership? This is GPP. This is a practice of profession. Okay, this is a practice of profession. So if the partnership, we look as to the purpose. If the purpose is a practice of profession, although we have here an income within or without, this general professional partnership is exempt from income tax. Clear? So partnership, we include in our income within or without, pero pagka GPP yan, it is exempt from income tax. Nasundan? So hindi mo itatax yung income ng GPP. Clear? Yes, sir, earned within or without. Kaso, nag-fall siya dun sa number 3. Sabi doon, di ba? It must not be exempted by law or treaty from taxation. Here, a GPP, sinabi sa NIRC, is exempt from income tax. So even if it earned within or without, exempt siya. Sir, how about a general partnership in trade or business partnership? This is taxable. This is taxable. This is taxable like a corporation. So it is taxable like a corporation, particularly a domestic corporation. So para siyang domestic corporation. Are we clear? Okay, partnership. Although you add the income within and without, you need to determine whether that partnership is a general professional partnership or a general partnership in trade. Sir, when can we say it is a general professional partnership? Sasabihin ng problem yan. But normally, if the partnership is for the practice of profession, included. But if the partnership is for business, then it is taxable. It is taxable as a corporation, domestic corporation. How about a joint venture? So normally, a joint venture is entered within here in the Philippines. So still a domestic joint venture. So either within or without. Domestic joint venture within or without. But for joint venture, guys, it is necessary again to look whether the joint venture is a venture with the government or not. So joint venture, whether it is a joint venture with the government or not, meaning other joint ventures. So sir, what is a joint venture? A joint venture is a business transaction that is entered into for a specific purpose. So, unlike a partnership, guys, long kasi yung business pa ng partnership. So, although may specific purpose siya, incorporated siya for business talaga. While a joint venture, it is only for a specific purpose. So, for example, selling tickets only on a carnival during December. So, hanggang December lang talaga yon. So, may specific term or period siya at based on specific purpose. So if the joint venture, you enter it with the government, this is exempt, meaning non-taxable. Why again? Under our limitation, you cannot tax government. You cannot tax government. Therefore, if there is a joint venture with government, it is exempt. Nasundan? So joint venture entered into for a specific purpose, but if the joint venture is with a government, you exempt that in taxation. Sir, why is it exempt in taxation? Because under our inherent limitations, government is non-taxable. So exemption of government, so we exempt the government. How about if that is another joint venture? This is already taxable. If it is another joint venture, it is taxable as a domestic corporation. You tax it as a domestic corporation. Clear? Next, co-ownership. So a co-ownership is a shared ownership over a property. So for example, namatay yung parents nyo. Ay, wag naman. May namatay. Tapos yung namatay, may naiwan ng mga anak. Yung mga pag-aari ng namatay, paghahatian ng mga anak. So yung before mahati yung mga yon, we call that co-ownership. Okay? Kasi wala pang specific na sa kanya. So co-ownership yun. So sharing of property which is owned by two or more persons. We call that co-ownership. Okay, so for co-ownership, whether it is within or without, it is taxable. Why? We consider a co-ownership as an individual or a corporation. Individual or a corporation. But actually, it is more of a corporation para hindi kayo malito. Okay, we consider this one as more as a corporation. So if that is a co-ownership, we look whether it is within or without, kasama pa rin yan sa income natin. Okay, so more of a domestic corporation na naman yan. But for co-ownership, guys, what we look into is the purpose of the co-ownership. So if the purpose of the co-ownership is for preservation or income collection, it is exempt. Okay, it is exempt. So what do we mean by preservation or income collection? So you have here a co-owned property. And you don't really make use of that co-owned property for business transactions. So purely for preservation, any income of that is exempt. Any income of that, exempt. But if ever it is an income with reinvestment, so in short, you use that co-ownership as a tool to earn more income. So for example, you have again a property, tapos kumita yung property. Yung kita niya, ininvest niyo uli. Ang tawag doon ay income with reinvestment. Here, it is now treated as a corporation. Therefore, it is taxable. It is taxable. Sir, how do we tax it? As a corporation. As a corporation. How about an estate or trust? So we have already discussed this as early as our beginning discussion or our first discussion. When we say estates or trust, estates, this is the undivided share of a decedent. So pag may namatay, yung properties niya, ang tawag doon ay estates. How about a trust? So we have here a grantor which gives a property to a beneficiary, but however, it is now held by a trust. Held by a trust. So tatlo dito, may grantor, may beneficiary, may trust. So ang nangyayari dito sa grantor, beneficiary, or trust, yung beneficiary, normally hindi niya pa kasi kayang hawakan yung property. Kaya ipapahawak mo na siya sa trust. For example, may minana yung minor, so it will only be held in trust because the minor cannot still manage that property. So estates and trust, taxable within, without, but estates and trust will be taxed as an individual. It will be taxed as an individual. Okay? It will be taxed as an individual. Okay. Partnership, joint venture, co-ownership, taxed as a corporation. Estates and trust, taxed as an individual. Clear? Okay. Next, we go to your last slide, taxpayer classification as to tax administration. So what is this as to tax administration? So when we say as to tax administration, the BIR classifies different taxpayer for easy administration of taxation. So they can easily collect them, and this particular taxpayers has a different mode of taxation, meaning yung iba naka-EFPS. Sir, ano yung EFPS? Yun yung Electronic Filing and Payment System. So, pwede kang mag-file through electronic, pwede ka rin magbayad through electronic. Pero meron naman yung iba na pay as you file lang siya. Okay. So, how do we classify them? So, the BIR classified them as large taxpayers or non-large taxpayers. So, large taxpayer, this is dependent on the threshold. So, may mga threshold amounts siya. So, pag pumasok ka doon sa threshold amounts na yon, you are considered a large taxpayer. So, kindly please research on the amount of your threshold. So, for example, VAT. If ever your VAT payable is 200,000 per quarter, then you are considered a large taxpayer. How about income tax? If you paid 1 million pesos income tax, 1 million income tax, you are considered a large taxpayer. So there is a different threshold depending on the type of tax. Okay? So there are threshold amounts based on the type of tax. If pumasok ka kahit isa doon, kahit isa, so whether the threshold amount is income tax, VAT, excise, withholding tax, percentage tax, pag pumasok ka doon, you are a large taxpayer. If you did not enter the threshold amount, you are considered a non-large taxpayer. Okay? So, again, for this particular video, we learned about your gross income, the situs of the income, and how should we tax your taxpayers, whether we include the situs of income inside and outside or inside only. Okay, so that's it for this video. Thank you, and I hope you learned something. See you on our next lecture. Bye.